Good evening, guys. Ken at Tortoise Capital, Saturday night podcast for November 19th, 2022. The swing trade review. We'll start with Chi Wing Chong's review of the RL30 slope Z score of key sectors. So we're looking at the S&P, which has worked its way from a minus 1.5 all the way up to a positive 1.5 Z score and is starting to stall a little bit. It's at a critical state. It was in this territory last surge that led to a collapse. Right. Finance, which has had the best run, is starting to roll over. Materials are starting to stall. Energy continues to decay, which we warned about a couple weeks ago. And when it left its leadership position, and now we've seen energy sector, especially oil, continue to weaken. Only technology right now is providing some strength, and that's actually some tentative good news, since the strength in tech could offset some of the gathering weakness in finance and materials, and tech could actually lead the way north and could give a little support to the S&P. So it's really technology's time right now to fish or cut bait. Now, in the comparison between offense and defense, we have XLY, which is consumer discretionary, is slowly gathering steam and is shaping up. Staples are rolling over as the S&P stabilizes. So again, this is the case where we're looking to see if the traditional sources of strength in growth, consumer discretionary, is going to be enough to keep pushing higher and keep the S&P going higher. Is this a rotation away from defensive plays? We're going to keep our eye on that as it approaches a critical state. So thanks to Chi Wing Chong. And thanks to Ken H. for providing us a great set of charts again this week. So we're looking at tech first. And this is the Qs. And Ken H., there were a couple opportunities in here for a SSC and a COTA 2 entry, and the logical exit would have been here. He was playing other patterns, but that strength right there is where that strength in XOK was coming from that we just looked at earlier, the Z score. Excuse me, had improved. This is an interesting location right here on the 65-minute chart that we've got sort of this double bottom, a tight wrist box. And I think you can see if that fails, it gets to here, and then that gap is closed, and it gets to 272. So there's a pretty clear price ladder all the way down to previous support, which would be here. And then on the daily, you can see we've got an opportunity for a test of about 295. If that breaks, then back to 305 is possible. And again, the failure here could take us all the way to 265. So I really like that as a critical state in technology, and I think that's going to be where the focus will be on leadership going into the week ahead. This is Cisco. So there's two large cap traditional companies that really have been stealthily cruising along on this strength in technology and leaving the others behind, and one of them is Cisco. This latest congestion zone has resolved to the upside. Ken H. gets his breakout entry here above the peak of the RL30, which is an emerging dragon. And so that there's really no resistance in here until you get to the peak of the dragon at about 48. So he's got a clear run to the upside available. And then if that breaks through, up to 50 is not out of the question. So Cisco feels pretty good. IBM is the other company that's been just really leading the way. And speaking of the devil, here's IBM, which the fireworks catches. There's leg one, leg two, and now it is peaked out up here above the previous resistance. The good question, how far back is resistance relevant? Uh, you know, anything past about 3 months is really almost ancient history. I mean, I think this is a target for long-term buy and holders, and all the guys that owned it here and endured all this, when this comes back up to there, these guys are saying, "Oh no, this is now an opportunity to sell to get my money out." No, they're saying, "Hey, this is a great American company, and they've bounced all the way back and are leading candidate for strength in tech. Are just going to hold on to it." So I don't see anybody that would look at this as a reason to sell, except the people that are in this current leg, right? And if they're going to sell, it's because they've decided that they've studied how much money they've made on that run up and how much are they willing to give back. So I view that as guys are willing to give back a half before they panic, right? So if we took that as the high, that as the low, to me, this is probably the support level that they cannot afford to let it go back further than that. So if this starts to stall, then you got to decide inside this space between 138 and 148, how much room are you willing to give it before it turns and goes? Because really, that's not going to stop this thing from going. It's going to go because people want to buy it. So how much adverse price action could you take? To me, it's about $4. So if I'm buying this at 147, I'm thinking about 143. That's my risk box on the longer term. Now you could tighten that up by being in here or even in here on the intraday. But to me, you need to have a belief that it could tolerate a $4 uncertainty on its way to make a move. So then you say, is there room for $8 to the upside? Because you want 2 to 1. So if it's at 147, to get to 155, that's easy to believe in, right? That's not resistance right there. So it's already above the hump of the dragon. And I think you're in good shape there. I would just look at this as, if you got this thing moving and it had $8 and tech was going to be the key leader, you'd see IBM have a lot of additional buyers, people who are trying to add positions from the gains that were made all the way through here. So I like that. I like that trade myself. It proved itself sooner than the other tech companies. Netflix. So sometimes it's better to be lucky than good. Ken H was good enough to get a long call option in here after seeing an SSC and a couple K2s. And he was able to get that above the congestion zone here. So he's got his long call. He was busy, and so he missed that normal exit right here. And he suffered all the way through here, and now he had a chance on the rebound to cash the win that he wished he'd cashed on the front end, and that turned out to be just in time. So Netflix, a nice payoff. So now we could look at this as holding. It came back halfway from this leg, and if this holds, you wouldn't be surprised to see it move back to 305, and that's a $20 move. That's an 8% move from here just to there. So that feels tradable. On the other hand, if that breaks down, you could see that's not resistance or support. Support hits right around here, so there's about a $15 move to the downside. Actually, $25 move to the downside. So this looks to be actually really, really tradable in that window right there. So good trade. Semiconductors have been very strong. They turned it around down here, an SSC, then a COTA 2, and now it has just been really on fire and has almost recovered its former former glory around 245, and then to realize that's just leg one, and here's leg two to get it back to 310 on the weekly. So this is really still early days in semis. His emerging dragon breakout play here, second position, and then he gave it just enough room, stopped in reverse for a scratch, so he's still in the money from the previous trade, and now playing this with it as a critical state to get started once more. I like that one. And again, this is going to be part of that tech narrative. If tech is working and leads the S&P, you'd expect the targets to me would be SMH, Cisco, IBM. We're going to see Honeywell here in a second. All of those. And then if you're looking strictly at SMH, you could then say, let's take a look at NVIDIA, Texas Instruments, and Intel. And in that group, Texas Instruments and Intel have been much better than NVIDIA. NVIDIA's been beaten down. So you could say, well, let me be interested in NVIDIA as a value play in the hot sector, in the hot tech region. Or no, let me stay with the current leaders in semiconductors if the semis go. So you got some real choices strategically. It's worth looking at all of those. And then if you just take a wider look at the tech sector, all three of the Cisco, IBM, and Honeywell have a lot of momentum behind them short term, so you could play that. Whereas Tesla, on the other hand, can only be seen as a value play. It's already broken key support levels here, and now that it's below 200 split adjusted, and this does not look promising. The more negative feedback he's getting on Twitter, the harder that's getting hit. Double bottom, which makes this a great place to play back to 200. That's a 10% move. And the further breakdown, you'd be with Michael Burry on that one. So Tesla remains the most important stock in the world, and it's in play. It is definitely in play tactically. Coinbase, you can see it's getting punished in the great crypto boondoggles. Ken H got paid here a little bit on that short. On the stop and reverse, ended up giving back a piece. And then it was too wild to continue to stop and reverse. And now this is stabilizing. I would start this one fresh on Monday and see how many people are reading the papers about crypto in general and just are going to pull the plug, or buying it on sale. So I think this is a great way to play crypto short term, the volatility in there. That's on the short list. Mark has been quietly getting it done. It was getting murdered down in this region while the rest of the healthcare sector was doing good, and it's done nothing but recover. Has had some short-term volatility, but it really closed well. And if it breaks out above like 104, 105, all is forgiven and all-time high, and you got to believe, you just follow it. Just hold your nose and buy it. Walmart, same by the same deal. It has really been thriving here, I think, going into the holidays. Low-cost way to get things done. 2 levels of resistance that resolve to the upside, great earnings. It's close to resistance here, but I think its momentum should carry it through that pretty nicely. I like the trend following that one and make it a core holding. ExxonMobil feels toppy. We talked about that last week as well. And now you can start seeing that whole weakness in the energy sector we alluded to earlier, as this looks like topping action here. And you got to be respectful of topping action energy, because when it collapses, it collapses. So this is all coming into the station, and this has already had one effort to fail. This was 2 good trades that terminated here, but I like the short, and especially short below 109. I could be tempted with 1 position short here, a second position there, thinking it could come back to 103. Energy is beginning to crumble, and wouldn't be surprised to see some more weakness in the weekend. XLU is hard to trade intraday. There's it doesn't have that much, but on a swing trade, it can certainly play. Here's your SSC and a COTA 2. A breakout above here, to me, says you could maybe try that as a defensive play to 76. So from 68 to 76 is plus 8. So if you can manage a $4 risk, which would be entering at 69 with a stop at 65, you would be well protected against a greater than 1 hour loss. I could even live with a $2 risk and make that a 4-to-1 reward to risk. So I like utilities as a defensive play. It's not like you can put it in bonds or the bank. So at least you get a dividend. Treasuries, the long national nightmare looks like it's over. Here's that first rebound with the bottom being put in. There's the SSC. Actually, that's kind of like a COTA. There's the SSC, and the dragon has rolled over. So this is an owl entry in here, and I think you can target 110 as a $10 upside as a swing pattern, and there's nothing wrong with that one. Failure below 99 could take it back to 97, 94, and then 92. So you got clear price ladders all the way down. And you can see that the last time it made on the weekly that it made this little rebound, when it failed, you got to respect that because there's another big sell-off in there. Each time it tries to rally after a sell-off and fails, that's a clear indicator the market's not ready for them yet on the long side. GFF, Griffin Corporation, this is a fireworks. Those very strong breakout to all-time highs here on the weekly, and the daily has left all this in the rear view mirror, and up it goes. I think, with about a 50-cent risk, following through on that one for a tactical trade, why not? I like it. If that fails below, say, 35, I think coming back to 33.50 wouldn't be a surprise. That's a pretty low risk trade. Juniper, also strength in tech. What I like is that it has cleared the previous resistances and closed well. So that could be part of the tech resurgence. And if you look longer term, all it's done is gotten out of the cellar. There's still plenty of room to get it back to 36 and the first significant resistance there. This is not resistance at all. This was panic selling. And so this could be panic buying. And so you got a $4 to the upside, and you only need about a 50-cent risk. So that's about 8-to-1 reward to risk. That looks good. Elevance Health, healthcare sector, managed healthcare plans. This sell-off, if it actually holds here, is still leaving it set for a COTA 2. Like this support level held, and if that holds, you're not allowed to be surprised if it gets up to 535. That looks like solid support, and it closed well going into the weekend. So I like the follow through on that one. Here's what I love about the materials sector. It is so orderly and key with the business cycle. Look at these long, beautiful weekly swings. And closed very well. Look at that PSAR flip. Holy smokes. There's our SSC. There's our COTA 2. There's still room to 137 for it to test. And if that breaks, it's up to 144. And that's a nice one. I would lump that into our management with U.S. Steel, Alcoa, the Wood, and Cliff. Estee Lauder has cleared resistance, closed well, and the next resistance is around 250. So you got about $16 to the upside, and if you can manage about a $5 stop, that gives you 3-to-1 and plenty of protection. So yeah, that's a nice momentum play. Didn't they just buy Tom Ford for like billions, the brand? So we'll see how that goes. It feels like they've sort of found their base and are still only 1/3 of the way back to the top. So there's room for them to go. Honeywell, just there's no better company out there. There's your SSC. There's your COTA 2. This is your emerging dragon. He's well in the money. I'd add a second position if it gets above 216, especially if we see continued strength in tech. That's just a great winning American company right there. Lastly, Steel Dynamics, maybe a new symbol to turn to add to our little steel group here, but it has held up, I think, a little better than Cliff and U.S. Steel, and it's above that previous resistance, so this can certainly go, and it's at an all-time high. So what's not to love? And then if it does fail out of there, coming back to 94 is not out of hand. So I like that. Great work, fellas. Thanks for your kind attention and due diligence, and we will get this published and posted and ready to go. Thanks a lot. We'll see you tomorrow.